Okay, good afternoon, everybody. Thanks again for your time today. My name's Chris McCormick. I'm a senior distribution specialist at Jaltech, and today I'm going to take you through our most de-risked Section 12B solar investment. Before I get into the content, just two things. We're going to share a recording of the webinar afterwards, so no need for you to frantically take notes to try and keep up as we go through things. And secondly, if you do have any queries as I run through the content, please put them in the Q&A or the chat box at the bottom of your screen. I'll do my best to get to, if we get any questions, to them at the end of the webinar. But if I don't, we'll have a recording of who posted that query, so we'll be able to pop you an email and respond to you there. All right, let's get into it. I think before I share information about the investment, I just want to tell you a bit about our approach to the solar market. So our approach to solar over the last few years has changed. Previously, our model was similar to other fund managers in the space, where we would partner with a solar installer or solar developer and really outsource the design of the system, the costing of a system, the installation, and then operation and management of that system to that third party. Obviously, there's a lot of trust going on there. And although we found a lot of really great partners in the space, we realized quite quickly that their incentives are different to ours and those of our investors. I say this because for a solar installer, they'd like to charge as much as they can for the equipment up front. They'd like to do a quick installation, and then they'd like to operate and maintain that system on as cheaply as possible over the term that we own it. Now, quite quickly, you'll see that those incentives are not aligned to what our investors would be looking to achieve from the investment. So in order to address this imbalance, we partnered, or not partners, sorry, we purchased a business called the Sun Exchange, who you may have heard of previously. And the reason that we did this transaction was to bring the human capital within the Sun Exchange business into the Jaltech stable. And so what this has allowed us to do is really build out our Section 12B and solar team at Jaltech. You know, before this transaction, we had everyone that you would expect from a fund manager in the space in terms of having a deal team, 3 full-time attorneys, a new business development team looking for deals in the market. But now we've also got a really strong operational side of the solar business here. So that team's headed up by Andre Porchita. He is a solar specialist. He's been in the solar industry for over 20 years. He really, really knows the game. And underneath him sit various people with different types of solar expertise. So we have an electrical engineer, and his role is to review a system's design when it's first submitted, check that the system or the equipment rather has been costed correctly. We then have project managers who can go out to sites and check that the installation is happening in line and on time and the workmanship is of a high enough order. And then finally, we have system monitors who sit behind computer screens and they review our solar system on a daily basis, or rather solar portfolio on a daily basis, and look at how the systems are performing. If they pick up any issues, we can send the solar operator who's got the operation and maintenance management for that system out to the sites to go and have a look what's going on. It might be an equipment issue. It might be the fact that the solar panels just need cleaning. Really, what you can see from a Jaltech perspective is that we've really got our finger on the pulse in terms of the assets that we have under management here and how they're performing. So what this has allowed us to do is develop a really solid track record over the last couple of years. So we've invested 850 million Rand. That's been into more than 250 solar assets across the country. And those assets produce just over 48 megawatts of power on an annual basis. So yeah, we've invested a lot in the space internally. We've got a really long-term view on the market, and we're hoping you'll be with us, over the next 10 years, should you invest. For those of you that aren't familiar with Section 12B, let me just take you through exactly what this looks like from a high level. So Section 12B was first introduced in 2016, only got onto the map for a lot of people in the past 2 financial years because the tax deduction was enhanced from 100% to 125%. That enhanced version of Section 12B has fallen away now, so the tax deduction is 100%. And the requirements for a taxpayer, an investor, to be eligible for the Section 12B deduction is that the solar assets that have been invested in need to be generating electricity before the end of February. And it needs to be solar assets, so panels, batteries, inverters, and so on. We can't invest in a generator. And I think just one more point here under Section 12B is that individuals, companies, and trusts can all invest in Section 12B and enjoy the tax deduction. To give you an idea of what the tax deduction actually does for an investor, we're going to use similar numbers as we go through the presentation. So if you wouldn't mind just kind of keeping these in the back of your mind as we go. So here we have a person earning 5 million Rand per year. This puts them in the 45% tax bracket. As you can see, they don't invest in Section 12B, so they don't have a tax deduction, meaning their taxable income stays at 5 million Rand, and they pay the full income tax of just over 2 million Rand on their income for the year. However, if the same person earning 5 million Rand a year invests in Section 12B to the tune of 1 million Rand, because it's deductible at 100%, the investor in this case gets a tax deduction of 1 million Rand, 100% of a million. So as you can see, what this does is it reduces the taxable income from 5 million Rand to 4 million Rand. The investor then pays tax on 4 million Rand. And that's just over 1,600,000. And that generates a tax saving of 450,000 Rand for this investor. So for those of you on the call who are provisional taxpayers, when you do your tax return to SARS in August, for example, you simply wouldn't pay the tax to SARS at that time. So you really realize the tax saving very early in the investment term. For PAYE taxpayers, you wait until e-filing season next year. You'll do the e-filing process, and once you're done and you've been assessed, you'll get a cash refund back from SARS at that stage. So that's how the tax deduction works. A big part of this investment is debt funding. We do this to enhance the return to the investor, especially in the form of the tax saving, which I'll touch on. What I'm going to do is just take you through an example of how the debt funding works. And then when I take you through the investment, I'll show you what the actual figures look like for the gearing. So in our example, same as earlier, the investor in the top tax bracket invests 1 million Rand and they receive the tax saving of 450,000 Rand. You'll see at the top of the screen that the debt funding is 1-to-1. So what this means is for every 1 Rand of equity that the investor puts in, we will look to raise 1 Rand of debt from a debt provider, and we will treat that debt capital exactly the same as we treat the investment capital, in that we go and invest it into solar assets. So what this means is your total exposure to the investment is 2 million Rand. Even though you only invested 1 million, we've invested 1 million alongside you. And so when you report to SARS, your exposure will be 2 million Rand. So you receive another tax saving of 450,000 Rand on the debt component. And what this means is that your total tax benefit for the financial year in this example is 900,000 Rand. So you invest 1 million, the gearing adds an extra 1 million to your investment. You have 45% of both. So you get 900,000 Rand back of your 1 million within the first year. So you can see quite quickly how the debt component of the investment really enhances the return in the form of the tax saving for the investor. Okay, I'm going to take you through the investment now. This is a residential Section 12B solar investment, slightly different to what we've done in the past. Previously, our focus was largely on commercial and industrial systems, with a small exposure to retail or residential solar systems. We're turning that on its head a bit for this fund, and one of the major reasons for that is we've partnered with a company, Utility, who you may have heard of. They're one of the largest residential and SME solar players in the market. They've been around for a number of years now. They've installed thousands of systems across South Africa. And we have financed their residential portfolios, obviously on a smaller scale previously, So we know the team there. They've been a great partner, and we're really, really chuffed to be getting closer to them. Having them on board as a partner brings a couple of other benefits that are really critical to Section 12B, which I'll take you through. And then just adding to this partnership is the fact that Metier, who's one of the largest private equity firms in Africa, owns a stake of Wetility. So what this does, obviously, is it just brings another level of security to Wetility as a business, and just obviously an important piece of information to share with investors. So you've got some background on who Wetility is and who backs them. All right, we're going to get into the investment now. So as I said, this is residential solar exposure. Investors will have diverse exposure of up to 3,000 homes. So, in your typical commercial and industrial Section 12B fund, where the assets are sitting on the top of businesses, um, you'd only really have exposure maybe to up to 50 off-takers. So 50 businesses where the solar is sitting on top of. Here, should we raise all the capital that we're looking to and we deploy all of that capital, investors will have exposure to up to 3,000 homes and all of the benefits that come with that type of diversification. We're also targeting to return up to 106% of investor capital within the first year. I'll take you through that. And then Wetility are contributing a 17.6% tranche to whatever we raise. So what this means is, if we raise 100 million rand, Wetility will contribute 17.6 million rand into that fund. Now, what this does is a couple of things. The first one is it immediately enhances the tax deduction. So for Jaltech, the tax deduction for this year is a minimum of 117.6%. So the 100% from SARS plus the 17.6% from Wetility. Wetility are not claiming the deduction on their side, as you can see. The second benefit here is that this 17.6% will also act as a first loss tranche. So if the portfolio underperforms at any time during the investment term, Wetility's capital will be eroded for investor capital is. So there's a level of capital protection here. And the third benefit is an obvious one in that Wetility has skin in the game with our clients or with our investors. So really important from a partnership perspective there, their capital is being invested alongside yours. And finally, there's a limited fundraise. So as I mentioned, Section 12B says that the capital has to be deployed before the end of February. So what we look to do is to raise capital as Wetility has a requirement for it. So rather than raising one large fund throughout the year, for example, we've just closed our first tranche where Wetility needed 75 million rand. So we raise the capital, we give them the 75 million rand, and then they tell us when they need the capital next or more capital. And that's where we are already with them. So this next tranche is open from today up until the 1st of August. So if you're interested, that would be the investment window for this tranche. And then as Wetility needs capital during the year, so we'll raise other tranches. I think an important point to mention is obviously investors who invest early reduce the deployment risk to a large degree because they give us and Wetility as much time before the end of February to deploy their capital. All right, so in terms of the key investment benefits, the first one is that this investment offers a 235% tax deduction. So we take the 100% from SARS, the 17.6% from Wetility, and then we're looking to add debt funding on top of that to bring the total tax deduction to 235%. So this is what that looks like. Similar to the example from earlier, but you'll see the debt funding ratio is quite different. Instead of it being 1-to-1, it's 1-to-1.35. So for every rand of investor equity, we raise 1.35 rand in debt. So a million investment, you get your tax saving of 450,000 rand there. Then the debt funding is 1.35 million rand. 45% of that is 608,000 rand. And if you add those two up, your total tax benefit is just short of 1,060,000 rand. So that's how we're aiming to return up to 106% of the initial investment back within the first year. And just as a reminder, As provisional taxpayers, you would realize this saving, this tax benefit now in August, and PAYE taxpayers wait until really just a year's time to get their money back from SARS. So I know the debt can be a bit confusing. If it is, I'll send you a follow-up email later today with the webinar recording. Just pop me an email. We can set up a call and I can take you through it. We also have quite a useful tax calculator that can help you look at your numbers specifically, your tax bracket specifically. So if you'd like access to that, just please reply to my email later today. Carrying on with the benefits, I've already touched on the first loss protection of 17.6%. So just a reminder, utilities capital, if the portfolio underperforms, is eroded before investor capital is. I've touched on the diversification of up to 3,000 homes. Now, just to reiterate again, this matters because if a small portion or a portion of the homeowners are defaulting, it doesn't affect the cash flows to a large degree. 50, 80 homeowners are not paying for a period of time. The majority of cash flows are still being generated. A contractual agreement that we have with utility here is that if a homeowner does default, they stop paying for their system, utility has to go and collect that system and put it up on the next available roof. So we're not going to sit on an asset that is not generating electricity for a long period of time and therefore not generating income for a long period of time. And so just to quickly touch on this, so you've got an idea, utility enter into subscription services with homeowners. So you'll pay 1,500 Rand a month for solar panels, battery inverters, for example. Obviously, the system differs and the cost differs depending on your requirements. And so the payments generated from those subscriptions are channeled through and distributed to our investors on an annual basis. I'm going to take you through what the cash flows look like in a bit. From a deployment perspective, so the question that we're answering here is, how likely are we to deploy your capital before the end of February and have make sure that you're eligible for the tax deduction? So utility have the following capital requirements: 350 million Rand for new solar systems. So these would be systems that are going onto homeowners' roofs for the first time. It might be an estate, a complex, or an individual home who doesn't have solar yet. They want to have cheaper power than they can get from Eskom and back up in case load shedding rears its head again. So here, utility are looking at really a new business pipeline of 350 million Rand over the next few months. And then really excitingly, we have utility has 150 million Rands worth of existing assets for us to refinance. So these are assets already installed, they're already generating electricity. What we do is, with investor capital, we take ownership of those systems. And by doing that, they're already generating electricity, our investors own them, and investors qualify for the tax deduction. So the likelihood of deployment for investors in this tranche is extremely high because, as you can see, there's some low-hanging fruit in terms of the existing systems, and then also a lot of runway in terms of new systems that utility are going to be installing over the year. As I said, they've been in the market for a number of years now. They've obviously got a great feel in terms of the demand in the market from homeowners to go with solar, and that's what these numbers are based on. Another major point here is that we've agreed a contractual exit with utility after 10 years. So it's a 10-year investment term. And at the end of the 10th year, we've agreed that utility are going to purchase the portfolio of assets from our fund, and investors will then be exited at that stage. Now, one of the major benefits of this is obviously you've got a line in the sand, but also utility just has skin in the game again. They're going to own this portfolio in 10 years' time. These are going to be their assets. And so what they're not going to do is enter into subscription services with homeowners or estates that are not creditworthy. They're not going to do quick and nasty installations. They're not going to use cheap equipment. So again, their interests are very much aligned with our investors, thanks to this contractual exit agreement that we have in place with them. And I'm going to take you through the cash flows now. Okay, so just a couple of assumptions to mention here. the investment value is the same as the example we've been going through. So 1 million rand invested, and the investor is in the highest tax bracket. So the first bar that you're looking at on the graph is the 106% that we return to the investor within the first year. Thereafter, the investment generates an income for investors annually, with the first one paid just after February 27. So just to say that again, the investment generates income on an annual basis for the investor, which we pay just after Feb 2027. Now, um, obviously, the partnership that you'd be investing into is generating a gross income, and there's a couple of things that you have to deduct off of that. The first thing is that the income is taxed as income. So SARS gives you this great tax deduction up front that we enhance through the debt, and then they tax the income to get their pound of flesh back as income. So whatever the marginal rate is of the investor is the tax you'll pay. Here it's assumed at 45%. And then obviously we have to pay the debt provider. So, in this type of investment, there's really two options from a structuring perspective is we could either look to get a large portion of capital back to the investor early in the term because of the debt, or we could not raise as much debt, get a lower amount of capital back to the investor early, and then have slightly higher cash flows over the term. We've chosen this structure because really what you're doing here is instead of paying tax to SARS and never seeing that money again, you're investing with us, you're being de-risked to 106% within the first year, and then you're generating this income on an annual basis after tax and after the debt's been paid off money that you would have paid to SARS. So looking at the income then, for the first few years, so 2027 to 2031, the combined yield is 6%. So the combined yield over that first chunk of years is 6%. It then goes up to 14%, and finally in the last 2 years it goes up to 19%. So in terms of the yield over the term, that's what you're going to be looking at. To show you the numbers in a slightly different format, and we're looking at the post-tax return here. So this is the income after the tax has been deducted. The total return after tax has been deducted off the income that we pay every year. So the investor invests R1 million, they get just short of 1.4 million rand back. The pre-tax internal rate of return, of course, is really high because we're returning so much capital to the investor within the first year. If you deduct the income tax off the distributions each year, you're looking at a 29% internal rate of return. And then a lot of investors say to us that they want to look at the investment purely from a yield perspective, which is to say the income that they're receiving annually without considering the tax benefits. Now, we don't think that this is the best way to look at the investment, not from a bias perspective, but because the tax benefits upfront means that the distributions are taxed differently than an investment typically would be taxed. So it's not capital gains, it's not a dividend, it's income. So we do think that you should look at the returns as a combined tax benefits and the distributions, which is the 68 and 29%. But let's strip the tax benefit out. So income yield on average from the first to the 10th year, pre-tax, you're looking at 14 to 17%. And after tax, you're looking at between 3.5% to 5%. So as I said earlier, just to round this section off, you've really got an option of either paying SARS and not seeing the money again, or possibly investing with us, generating a 6% term return in the first year, 106% back within the first year, and then generating a yield on basically SARS's capital over the 10 years. Just, I think finally, so you've got clarity, is in the 10th year, when we sell the assets back to utility, investors will be exited at that stage. They'll have a final income distribution as they've been receiving all of the other years. They'll pay income tax on that, and that's the end of the tax obligation. There's no capital gains tax at the end of the term because we're returning the capital to you through the SARS refunds at the beginning of the term. All right, so to take you through the risks, the first is debt funding availability. So what this says is the process that we have to follow for the debt is we have to take or raise investor capital first, deploy it into solar assets, and then we can close the debt facility and deploy that capital. So there's a level of trust with investors to say, you know, Jaltech can raise the debt. To give you some context here, we're really confident that we will raise the debt. The reason being, we've already raised a few R100 million in debt for our Section 12B funds previously, so we've walked this road. And secondly, we've had a number of meetings with the debt provider already for this fund, and they're really, really keen to come on board. We've had a lot of very positive discussions, to the point that we got some great news last week that things moved ahead really well. So we're looking really solid on the debt, and raising it, so providing investors the 235% tax deduction. We just can't give any guarantees at this stage. Then there's deployment risk. So as I mentioned, and I'll just use an example here. If someone invests R1 million and we only deploy 50% of that between now and the end of February, the tax benefit will be based on 500,000 Rand. So SARS will give you a deduction on 500,000 Rand. Then we'll look to deploy the balance of capital in the next financial year, where you'll get another tax deduction. We don't see for early investors deployment risk being high for the reasons I've already mentioned. Number one, we've got a lot of time between now and the end of February. And number two, as you can see, utility are really capital hungry. They've got existing assets for us to outright purchase, which is a quick transaction, and then to roll out the 350 million Rand of new solar systems. In terms of credit risk, so the credit risk is obviously we're relying on homeowners to pay their subscription fees every month, and if they don't, investor returns will be reduced, for that period of time. So we mitigate this credit risk through a couple of ways. The first one is the diversification of the portfolio. We're looking to have 3,000 underlyings here. So, if a percentage of those default, it won't derail risks, derail the return in a significant way. Secondly, utility does perform a credit assessment on every homeowner that applies for the subscription. And finally, the 17.6% first loss. So if the portfolio underperforms, utilities capital will be affected before investor capital will be. And of course, as I mentioned earlier, we will redeploy, or utility will redeploy the systems on the top of roofs where the homeowner has stopped paying to the next customer that they're onboarding. Then in terms of debt risk, so first things first, and most importantly with the debt, is that the debt provider only has recourse against the existing assets in the partnership and not against investors or limited partners. So you're not signing surety for the debt, you're not on the hook for the debt. Probably the most important aspect here. Next, though, obviously, when you raise debt in an investment, it does increase the risk profile of it. So what the risk looks like is, as an example, the debt provider in the 6th year of the investment decides to repossess the assets, and then they decide to sell them. The investor will pay income tax on the sale value of the assets without receiving the income. So basically, what's at risk is your initial investment amount. So I hope that covers that for you. And then finally, in terms of legislation risk, we're not sure what the government or Eskom are going to do in the future in terms of changes to the legislative environment for residential solar. Obviously, if anything comes up, we communicate that to investors. Utility know the space hell of a well, as do we. There are no major red flags in the short term. We think that investors who invest now will be fully deployed before any major legislative risk pops up. So, we think risks for investors now would be low. And then we'll have various risk mitigants in place should these types of things pop up. And I can tell you, for obvious reasons, the solar industry in South Africa is significant these days. And so any changes that Eskom does try and enact is met with a lot of contestation if it's not in the best interest of the customer. All right, so just to summarize, the minimum investment amount is 500,000 Rand. The tax deduction is between 117.6% and 235%. We believe, because of our confidence in raising the debt, that the tax deduction will be 235%. It's an asset-backed investment, of course. Investors are exited through those distributions. I've already mentioned the fundraising cap. So this tranche is open between now and the end of the month, end of August, sorry, end of July. And then we distribute income to investors annually over the 10 years of the investment term. And finally, just our fees. So for those of you who invested with us in the last couple of years, you'll see a very slight change, and that's to the performance fee. So first of all, our management fee is 2.25% per year. Then we charge a performance fee. First of all, we don't earn a performance fee. We can't earn a performance fee in the first 4 years. Then in the 5th year, if we return an amount above the hurdle, we charge 15% on that amount. So for example, if someone invests 100 Rand, the annual hurdle is 10 Rand. In year 5, we return 12 Rand to the investor. We charge the performance fee on the 2 Rand, so the difference between the hurdle and what was returned above it. In the next year, if we return 8 Rand to the investor, we miss the hurdle. We don't earn a performance fee. And in the following year or years, we have to catch up the underperformance before we earn a performance fee again. So the portfolio really has to be generating, and we have to be returning capital to investors before we can earn a performance fee. There's a charge or a fee on the 20% on the sale of the assets at the end of the term. And then when we raise the debt, a once-off fee of 2%. I think importantly, the numbers that we were going through earlier are all quoted after fees. So from the 1st year to the 10th year, we've assumed that these fees that we're looking at now have been charged across the board. All right, that brings us to the end of the presentation.